Thank you so much. All right, good morning, everyone. Thank you so much for attending. A lot goes behind trying to create content and deliver value that can help our partners grow in their business. So this month's topic is specifically around what I like to call funky type of lending. So things that don't fit the box of Fannie Mae, Freddie Mac, FHA, VA, and USDA. Like, how do people buy properties? Whether they're looking to live in it or whether they're looking to get into the investment world, like how do they make it happen? So this is a lot of the stuff that we'll go over today. So our first thing that I'd like to share, there we go. All right, is who we are. So many of you know who we are. Some of you don't. I think most that are on right now do, but we are the Turco team. We just moved our team over to Cross Country Mortgage back in January. And those Google reviews are between myself and my wife. We have 169 five-star Google reviews, which is more than most companies. So there is a track record behind the education that we try to share and the way we guide your clientele to their goal. But my wife, Yasmin, and myself are the lead advisors and loan officers. Our team consists of the great Candy Erickson, who is in charge of communications and assists with, the process of a client being introduced to us all the way through being pre-approved, shopping, and getting under contract. And then the expansion of our team has grown to add David Pace and Kelly Slattery, whose photo is coming soon. That's why it's there. She has to take a headshot. But David's a guru around condos and guidelines and getting like condos FHA approved, spot approved. Like he's like one of the best people I've ever worked with in this business. And then Kelly's our loan processor. She takes us from conditional approval all the way to close. So that's all I'm going to share about us. We will take great care of your clients if you're willing to trust us with them. So here's why you really came for the lesson. All right. So what we want to see is educate our partners on how to grow their business with stuff that's outside of the traditional mortgage. And Cross Country has a ton of different programs where we use our own money. So these are not loans that fit Fannie Mae's guidelines, that fit FHA's guidelines. They're things that are just like a little bit off that will not allow them to buy it from us. So we do stuff with our own money, right? So at Cross Country, we have our traditional Fannie Mae and Freddie Mac programs. We have our state bond programs like Mass Housing, New Hampshire Housing, Rhode Island, and just about one in every single state. We'll do your standard FHA, VA loans and jumbos. The add-ons that we have is we have bridge loan programs, construction loans, land loans, reverse mortgages. We also do home equities, and we finance for business purposes as well. And the big one that we're going to talk about is like kind of a third off the bottom, which is non-qualified mortgages. Okay. So what is a non-QM? It stands for non-qualified. All that means is that it doesn't fit the mold that is set by Fannie and Freddie. So they will not buy the mortgage if we write it. It does not fit the mold of FHA, VA, or USDA. So they will not buy the mortgage from us if we write it. So anything that doesn't fit that bucket is considered a non-qualified mortgage. So what's very typical with them is, clients that don't have W-2s, pay stubs, or tax returns, some clients that are heavy with assets, ITIN clients, investors, and people that have very complex calculations and tax situations. These are the solutions that they go through. Okay. So some of the programs that I'll share with you guys is an asset qualifier where we can use the balances that your clients have accumulated in their life between retirement, savings, trusts, and make an income calculation off of that. So they have no workable income, but we're going to qualify them based on assets and create an income calculation. We have bank statement programs where self-employed borrowers can use the deposits that are happening within their bank accounts to qualify as the income portion of it. Foreign national is a big one. My wife Yasmin and I have a little pocket of athletes in England that like to invest in the US on this coast. They're considered foreign nationals. So they want to invest in US property ownership, but don't physically live here. So this is kind of like an expat program for it. So full doc is one that we'll get into. It's a solution for people that don't fit standard guidelines, and there's like one thing that's off. Cash flow loans for investors or where the rent covers it. We can qualify off a 1099 P&L, verification of employment, and then clients that have an ITIN. So they have a work authorization and ITIN, but no social. So there's financing options for them. So the highlights that these programs allow is that they're flexible for clients. The client doesn't meet the mold of traditional financing. So how do we help them attain their goal of home ownership? So it's very flexible. Income calculations are not traditional. So we'll do funky things to qualify income. And underwriting is based on common sense. So because it's our own money, if you have good credit and the numbers make sense or the deal makes sense, like it's a risk that we would be willing to take with our company. So here, this is a big point to kind of hear is that it's very exception friendly. 35% of all mortgages that are written as a non-qualified mortgage contain an exception within them. So we'll talk about some of those, but it goes back to that common sense underwriting that if a client's creditworthy and it makes sense, like we'll do exceptions as well. So documentation is streamlined. A debt service coverage loan can close in a matter of weeks. Seasoning for credit events like bankruptcies, foreclosures are shortened, late payments, stuff like that, so we can get around the rules of Fannie and Freddie. There's interest-only options for 30 and 40-year terms. And the big one that kind of tends to land in this is non-warrantable condos. So, and also condo tells, which isn't as common, but on non-warrantable condos, right? So you run into probably running into this more often where a complex has an insurance policy with deductibles that don't meet the new rules of Fannie and Freddie. So the insurance policy renews once a year and the HOA doesn't want to make any changes until that renewal period. Unfortunately, it falls into a non-warrantable condo, but we will finance that. And then one of the other points is that all of these programs will allow you to close in an LLC, a trust, or a corporation. Standard mortgages, you can only close in the name of a person or a revocable trust. And these programs will let you close it in an LLC or a corporation. All right. So we're going to go a little bit more in detail with each program so that you guys have a little bit more knowledge. So the first one is a bank statement program. Okay. So this is very common for self-employed individuals that take a ton of deductions on their tax returns. And when we look at their tax returns, their qualifying income is very low. And that's because they're taking advantage of tax, like the way tax code is written. So it's not that they don't make money, it's that they don't show money, right? So then what we can do as an alternative is look at the cash flow of the business within their 12 months of bank statements. So we'll look at the money coming in and the money going out and calculate a debt ratio just based on that cash flow. So this is very common for borrowers who are self-employed, have non-traditional income, or they have inconsistent cash flow. Like they make 50 grand this month and 5 grand the next month, right? Underwriting method is simple. It's also open to people that have ITINs or part of the DACA program. But what you'll see with these programs is that the minimum down payments are a little bit higher, right? So you can't buy a home with 3 to 5% down. So for the bank statement program, it's a 10% minimum down payment. FICO scores a minimum of 620. We can do as little as $100,000 loan all the way up to 3 million. And then you can get a fixed mortgage in a 40-year term, 30 or 15, or you can get an adjustable rate mortgage with a 5-year, 7-year, or 10-year fixed mark. And when we calculate the money coming in and the money going out from their bank statement, we'll use a ratio max of 50%, which is pretty high. Okay. Next program that has a solution for clients is called an asset qualifier. So these are for clients that maybe sold their business and went into retirement and now don't have income anymore, or they entered their retirement phase and they went from making $100,000 a year to just pension, Social Security, and the money they've saved. So this is not based off of anything other than the assets that they have. So checking accounts, savings accounts, investment accounts, retirement accounts, cryptocurrency, estates, trusts, CDs, all of that is used towards the calculation. So the nice thing about this is that we don't require the liquidation of any assets. We just need to know it exists. So we're never going to ask a client to withdraw money from their retirement account to qualify for this. We just need to see that it exists, what the balance is, and then we'll come up with an income calculation based on that. And it'll typically be, balances divided by anywhere from 240 to 360. It depends on their credit score, right? So if you have a 620 credit score, we're probably going to divide by 360, which gives you a lower income calculation. If you have a stronger credit score in the upper sevens, we're probably going to divide by 240, which gives you a larger income calculation, because there's more reason to believe that higher credit score will pay their bills, right? So high net worth borrowers are typically who you're going to run into with this, right? They have a lot of savings, $500,000 in the bank, $1 million in the bank, millions saved, but not a lot of usable income because they're at a later stage in their life, or maybe they've just changed jobs or sold a business, right? So same thing, 10% minimum down, 620 minimum credit score, same options for programs, 40, 30, or 15-year fixed. And then on the adjustable rate mortgage, you have a 5, 7, and 10-year fixed ARM. And then that IO stands for interest only. So there's an interest only option on the ARM. Why somebody would do interest only? I don't know, they're expecting to come into some money and make a large principal balance or pay off the mortgage pretty quickly. Or they only intend to have the property for like less than 3 years. Those are reasons why a client would consider interest only. On our cash flow program, this is probably the #1 program for an investor. Okay. This is not for primary residence. This is for investment property only. And the way it works is that if the property itself, the rent that's expected to come in, pays for the mortgage at least like 75% of it, you're approved. As long as you can make a 15% down payment, have a 620 credit score or better, there is no personal income looked at or calculated. We don't need any tax returns, any pay stubs, nothing. It's just, do you have the minimum credit score? Can you fund the minimum down payment? And would the property pay for most of itself? Okay. So the beauty of this is that it's an easy way to just pick up properties, right? DSCR, it's known as the debt service coverage ratio. It's one of the most common ways that an investor will buy a property, and just based off of the cash flowing. So who benefits from this program? Experienced mom and pop investors, long-term financing options. It exists because traditionally an investor would go to hard money loans, which have higher interest rates and balloon payments. The beauty of this is that the interest rate offering is way better than hard money loan. It's more of a long-term solution, and there's very minimal documentation involved. If somebody's willing to make a 30% down payment or more, then whether or not it cash flows, we don't care because of the amount of equity that's being built. And here's another kicker that a lot of programs don't allow: short-term rentals. So if you're in like an area that's known to be like an Airbnb and you want to buy a condo, a single family home as an investment, we'll use AirDNA software, which basically gives average seasonal rental amounts for us to use as the rental income figure to see if it'll cash flow. So I'll open this up to questions as we go, I promise. So next one is foreign national program. So this is the one where, I mentioned that we have a little pocket of athletes over in England that are not US citizens. They're not US residents. They don't have any legal right to be here other than to visit. But what it allows somebody to do is buy a property in the United States for the purpose of investing. So the down payment is much higher on this one, requires a minimum of 25% down. And it does say that there's a minimum 620 FICO, but in reality, there is no credit score required because a foreign individual that is not living or operating in the US will not have a credit score within our system. So no minimum FICO score. We qualify off of one of two ways, either their assets or the property's ability to pay for itself, like on the DSCR program we just went over. So no debt ratio, no personal income. If somebody has foreign liabilities, we do not verify that. So if they own a house in Spain, another one in North Africa, like we don't count those liabilities against them. We're just looking at, hey, can you make a 25% more down payment? And if the property was rented, would it pay for itself? So on this one, the 40-year option is not available. It's just a 30-year fixed, 15-year fixed, or an adjustable rate mortgage with a 5, 7, or 10-year term. But this is a great way if you run into any pockets of foreign nationals, expats, they have different terms. But somebody that doesn't live here that wants to invest in the US. Okay? Now, another program available is 1099 calculations. So this is very popular with a lot of like real estate agents like yourselves, gig employees that are doing stuff like Uber, musicians, people in the performing arts that receive like multiple 1099s from different employers. And they're mostly commissioned or they're independent contractors. So this is a streamlined documentation option for qualified borrowers that have at least a 620 credit score, can make at least a 10% down payment. And what we do is we basically just gather all their 1099s over the course of 1 or 2 years. 2 years for lower credit scores, 1 year for higher credit scores. And we just make an income calculation off of that. So we're not looking at how it reports to their Schedule C, how they take deductions on their tax returns. We're just looking at the raw gross receipts on those 1099s, and we use 90% of what's reported. So really, really great solution, very, very popular for real estate agents, especially when they start to move that 1099 income to their Schedule C, take so many deductions for like advertising costs, a lot of deductions for like membership fees that we can't add back to the income calculation. This is the way around it. Okay. Next program we have is for profit and loss statements. So if a business owner has a professionally prepared P&L, 12 or 24 month, we will qualify them just off of that P&L. So no 2-year tax returns, no looking back at what's going on. It's a verified third-party profit and loss statement over a 12 or 24-month period. And it has to be prepared by a CPA, EPA, or CTEC. Most of your clients are only going to know what a CPA is. But that basically, that profit and loss statement has to be certified by them. So clients that fit into this bucket mostly are self-employed, don't have traditional income, cash flow is inconsistent, and they also take a ton of deductions, but the P&L will show the money coming in and out. So it's an alternative to like bank statement option for a lot of self-employed individuals. This one has a higher down payment requirement, at least 20% down, minimum of a 680 credit score, but the debt ratio will stretch it to 50% based off of that P&L. Verification of employment only. I honestly can't say I've ever done this program because in the traditional mortgage world, we use verifications of employment all the time to verify like overtime, bonuses, and just get like an average calculation of figures for employees. So this would typically come into play if a client had like a credit event that made them not qualified. So I'll give you an example. A credit event that disqualifies someone from getting a mortgage is if they've had a late payment on a mortgage in the past 12 months. So if that's happened at all, they can't get another mortgage until a full 12 months has passed since that late payment. So this program, we can use the verification of employment and kind of, allow up to 3 late payments in a 12-month period. Also, if anyone's filed for bankruptcy before, the waiting periods for FHA is 2 years, conventional is 4 years before they can qualify again. This is a way around it as well with the non-QM programs. Okay. And then a well-known one is ITIN, right? So client has a legal reason to be in the US. They have a work permit, they have a work authorization, they have a high-end visa, but they only have a tax ID number. We can do financing off of the tax ID with our ITIN program. And everything else follows traditional income calculations, but minimum 10% down for a full doc program where we look at pay stubs, W-2s, tax returns, 15% down if we're just going to look at cash flow and a bank statement, and 25% down for your ITIN borrower that wants to buy an investment property and see if it can qualify just off of the cash flow. Okay. So some of our programs allow like unique property types. So the one thing that I want to clarify is in the manufactured home space, it has to be a double wide and the land has to come with the manufactured home. So we still don't have a solution for leased land, residential owned communities, unless they're part of like an approved list with Fannie. But we can do manufactured homes in this program if they can't qualify with traditional ways, with these outside of the box ways of calculations. One of the bigger things is that we'll allow mixed use properties. So there's a lot of rules around mixed use properties with Fannie Mae and Freddie Mac. A mixed use is only allowed on a single family, and the business that comes with it, you have to occupy that with your own business. FHA allows 1 to 4 family units with a storefront being one of the units, and you don't have to occupy it with your business, right? So anything that falls outside of that norm, like how does somebody buy? How does someone buy a 6-unit apartment building that has a store on the front, right? So these are the programs that they go to that. So they're not required to occupy it. They don't have to own the business or operate the business. And we'll use up to 30% of the rental income from the business unit to help qualify. We'll use 75 of the residential, 30% of the business rental income to qualify them, along with their own income, because we can do full doc, bank statement, asset qualification, all of the ones that we just went over can mix in there. Okay. So our full doc program is the ones where like someone just misses qualifying for Fannie or Freddie. Like there's just some nuance that we can't get to. The major benefit to this one is the maximum debt ratio allows us to go up to 55%. With Fannie Mae and Freddie Mac, it's 49.99 and sometimes lower depending on the credit score. This will let you go up to 55% of the income. So we'll usually run into this when a property is unique, like it's over 20 acres or it has an ADU. Especially with like Massachusetts laws changing. If someone has a 4-family house, they can build an ADU on the property now, right? Like who's going to finance that? It's a 4-unit with an ADU, or it's a 3-family that was condoized and there's an ADU attached, right? So these are the solutions to like funky types of properties and programs as well. 10% minimum down payment, 620 minimum credit score, going up to $3 million in the jumbo space as well. So one of the beautiful things that tacks on to this full doc program is what's called buy now, sell later. Okay. So this is very, very unique program that is advertised by like some companies like Annie Mac and other institutions, but this buy now, sell later in conjunction with our non-QM full doc, what it does is it allows a client to buy a property without the contingency of selling. So when we go back to the full doc program, 10% down payment, that max LTV of 90% means they have to have a 10% down payment of their own money. So it's not a bridge loan. We're not giving them any money. What happens is that if they have at least 20% equity in the home that they plan on selling and have the physical ability to do at least a 10% down payment on the new place that they're buying, will also require reserves, and reserves can be retirement accounts and just money somewhere. We'll let them buy the new place, close on it, without counting the debt of the current property they own against them. The only requirement the client has to do is write us a letter that says, hi, we intend to sell 123 Main Street within 90 days, and it's going to be listed with XYZ agency. That's all. So that is their written commitment to sell the property. It doesn't have to be live on MLS. It doesn't have to be listed or sold. It can still be going through the prep stages with you. And they can buy and close on their new property and make an offer with no contingency and basically just relieve a big pressure in life. Okay? So I hinted earlier in the webinar that 35% of the mortgages that are written in this non-QM space has exceptions. So a common exceptions, just to kind of show you, is no landlord history. We can make an exception. A lot of these programs have a 10% or more minimum down payment. Well, if it makes sense and the client can only financially do 5 or less or 5 or more, then we can entertain that as an exception. Those credit score exceptions as well, 620 minimums for a lot of them. We'll take a look at that. So if we need to do a loan less than $100,000, more than 3 million, we'll look at exceptions around the loan amount. If a debt service coverage ratio program doesn't seem to pay for itself, we can always entertain that. Excess insufficient fund fees on business bank statements, declining deposits, multiple non-warrantable condo features. The one thing that we will not touch is structural issues. Nobody will lend on that. That's a cash buyer. So if structurally the complex is sound and there's no litigation pending, we'll pretty much finance it, right? If it's just an issue with like budget, reserves will be typical ones. Or maybe like owner concentration mix could be one of those things. We'll look at exceptions on that. Housing payment history, if you've had more than one late payment in the past 12 months, we kind of touched on that. If you own a business with somebody else and you own less than 51% of it, we'll look at still allowing you to use the business assets to qualify. Acreage is one. If you go into the more rural areas of New Hampshire, Maine, Vermont, where it's a single family home with 50 acres, there's not a lot of people that will finance that. We'll look at over 20 acres as well. Hobby farms is a kind of like a big no-no where you have an operating farm on the property. It's for personal use, but you also maybe support the community and sell some of it. So a multi-unit with an ADU, kind of touched upon that. We'll look at that. If somebody's short on reserves, self-employed for less than 2 years, if their foreign assets are not an approved list, meaning the bank or the country it's coming from, we'll look at that. Oil and gas leases we'll look at for income, employer assistance being gone in. And then we'll even look at unique income calculations to try to make it work. So this is cross countries own money in these programs. We also have outlets to broker out other programs like fix and flip for investors, construction to permanent, but we do a lot of them in-house with our own money. So, the owner of our company, Ron, is very, very in tune with if it makes sense and it can make him money, he'll lend the money out. So Very, very in tune. So kind of rolled that through that. These webinars tend to run about 45 minutes to an hour. This one's going to be on the shorter end of that and opening it up for questions. But what I want to remind everybody of is that we are mortgage lenders. As I touched upon in the beginning, we have over 169 five-star Google reviews with testimonials from clients that will give you surety that you are in good hands.